March 11th, 2020. Dr. Anthony Fauci testifies before the House committee. His words?
Things will get worse than they are right now.
The Jazz vs. Thunder game gets suspended just before the tip-off, and President Trump addresses the nation announcing that he's suspending travel from Europe for 30 days. The next day, the S&P 500 dropped almost 10% in a single day. Investors rush for the exits as news promulgates the impending doom of a worldwide economic shutdown. This is the story that we all know and remember. The story of how a black swan event ravaged the nation and took the stock market with it. But in the midst of the panic in the financial markets, not all funds were down. One such fund was up 39.21% year-to-date through March 16th. The Arin Large Cap Theta Mutual Fund, which is now the Alpha Architect Tail Risk ETF, ticker CAOS, soared up when it seemed like everything else was crashing.
With me today, I have Alpha Architect co-CIO Jack Bogle to discuss how CAOS is able to produce these returns when the markets are in turmoil. Welcome, Jack.
Thanks, Jose. Glad to be here.
So Jack, with investing, we don't know when a truly life-changing black swan event could come about. And for investors who maybe cannot afford to lose that amount of money that fast, whether that's psychologically or financially, having a diversifier that can potentially defend from these scenarios is crucial. Could you guide us through how this fund brought about this return? How can a fund go up when it seems like nothing else is working?
So products that attempt to defend portfolios from fast and meaningful crashes are often referred to as tail hedging products. Some of them purchase protective puts as their main exposure. A protective put is a contract that allows the buyer of the put option to sell an asset at a pre-specified strike price by or on a pre-specified date in exchange for a premium paid to the seller. So for example, let's say I purchased an S&P 500 put expiring in 3 months with 4,000 as the strike price. Right now, as of the date of the recording, the S&P is hovering around 5,500. So by outlaying cash and purchasing this contract, I am betting the S&P will drop significantly in the next 3 months. If it does, the put contract is likely to rise in price significantly to where I'm able to either sell for a profit, or if it's well below 4,000 and close to expiration, I could decide to simply exercise the put and realize the difference between the price of the S&P upon the exercise price and 4,000. If the market continues to go up, the option would reduce in value. When purchasing a protective put position, an investor must decide on the put option's strike price. In general, put options with strikes closer to the current price level cost more than put options with strike prices that are further out of the money. This pricing differential is because larger drawdown events are less likely than smaller drawdowns. For these further out of the money put options to pay off, there needs to be a significant volatility spike, which normally occurs in a rapid drawdown, such as in March of 2020. In the world of options, the more unlikely the payoff of a position, the more it tends to pay off in case it does. CAOS provides this defense by targeting puts that are 30 to 60% out of the money.
Now, one of the more interesting components of this fund is not just that it has that defensive component that can soar when the market is crashing and volatility is pronounced, but that most other years the fund is not losing crazy amounts of capital. Put buying can be prohibitively expensive over the long term, as investors are likely to buy put options that simply expire out of the money. This could be a cash burn, like constantly paying for insurance and never having any events covered by that insurance. Remember, fast downturns are unlikely to materialize, so tail hedging can be a really tough exposure to hold over the long term. CAOS attempts to make it easier to tail hedge by actively managing the collateral so that the fund hopefully also earns net positive returns over the long term. So Jack, why don't you tell us a bit about these strategies? What does CAOS do to help minimize or completely cover the cost of tail hedging?
So CAOS implements 2 strategies in addition to the protective puts. The first is the selling of put spreads. A short put spread is a strategy whereby an investor simultaneously sells a put closer to at the money, receives a premium, and then utilizes part of that premium to purchase a further out of the money put in order to limit losses. This results in a net positive premium paid to the fund on the day of the purchase. The return on this trade can be positive or negative depending on the market movement and the strikes on each put. However, it's important to note that even if the underlying were to drop significantly, the short put spread is partially protected by the long leg of the strategy. Therefore, while losses are possible, they are defined. Notice that the short put spread benefits from appreciation in the underlying. So even though the protective put positions in CAOS could benefit from a sudden crash in the index, such events are rare. These short put spreads, therefore, can provide the portfolio with modest returns during normal periods of appreciation, while helping offset the costs associated with protective puts. Lastly, CAOS implements box spreads, which can be thought of as a cash alternative.
Got it. So CAOS attempts to bring about explosive returns during times of market volatility while seeking to bring about net positive returns over the long term. And making sure that no strategy has undefined losses, meaning when positions are entered, there's already a predefined loss for that position. That sounds pretty good, but we know that not everything is all rainbows and butterflies. Jack, when should an investor expect CAOS to not perform well? In what market scenario should one expect this fund to not properly defend a portfolio from declines?
So CAOS is really designed to profit from fast and meaningful crashes, like March of 2020. But it's not necessarily designed to withstand slow-moving crashes like 2022, where there is not a significant volatility spike as large as the one in 2020.
Now, even though tail hedging can protect against slow-moving crashes, this is only one of the potential scenarios during a market downturn. There are slow and fast-moving crashes. So while CAOS may not shine during a slow-moving crash, it's important to be prepared for any scenario, such as a March of 2020. We believe that advisors and investors who want to diversify their portfolios and hold something that's truly uncorrelated to the market, especially during market crashes, should consider CAOS. If you want to learn more, you can head to alphaarchitect.com/funds/CAOS or get in contact with any of us. We'll be happy to answer any questions you may have. Thank you for watching, and we'll see you next time.